We're solving still to the mid-teens return, but that mid-teens return has a lot more conservatism baked in.
My fellow Americans, this is Liberation Day. Waiting for a long time. Make America wealthy again. Gonna make it wealthy, good and wealthy.
Probably the most direct impact on real estate for tariffs is going to be around things like construction costs.
Foreign leaders have stolen our jobs. Foreign cheaters have ransacked our factories.
Even though you have that negative, I think the big positive would be a reduction in new supply.
Before the tariffs, there was high cost of capital with borrowing costs, higher construction costs. And then now with the tariffs, it's almost like the nail in the coffin with supply.
Yeah.
In a few moments, I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Reciprocal.
What does that mean? I think with multifamily, that means a really strong 2026. I think you're starting to see positive trade-outs now in 2025. I think these patterns that you're seeing with muted construction forward-looking is a recipe for success for future rent growth.
If it's something that's going to have kind of a binary outcome, we think it makes more sense for us to be in the equity seat where there'd be a lot of upside and still potentially a lot of downside if it doesn't pan out, versus being on the debt side where you have capped upside but still all the downside. We are actually pretty bullish on office and on regional malls.
Sounds contrarian, no?
I realize that's contrarian.
All right, everyone, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and this week we got good friend Greg Rollman. Greg, how you doing, man?
I'm good. David, thank you for having me. I'm excited to be on this podcast with you.
Greg, I think you're making your rounds. I think when I reached out, I saw you on BizNow, so it looks like you're on a marketing tour right now, crushing it on panels, virtual. Could find you anywhere at this point.
That's the nature of the real estate business, right? You gotta put yourself out there. I don't need to
For
tell you
sure.
that. You obviously started the podcast, so
Yeah,
I'm
I took
preaching to the
that.
choir.
I took that a little bit
Yeah.
extreme with the podcast, but you know what? It's been a good time. It's a good excuse to talk to smart minds like yourself. So you know, any excuse is a good excuse.
I appreciate the flattery.
Yeah. How was BizNow, by the way? Did you get any like good insight, any unique perspectives? What really stood out from that conference that you took away from it?
Yeah, I mean, it's, like the panel that I was on was with some investors who have a much more institutional platform. I think they're with Heitman and with Principal Insurance. So different perspective. They're more capital allocators versus us being a kind of a smaller, more nimble private equity fund. But yeah, it's at the end of the day, especially investors like Heitman and Principal, where they do a lot of debt, their perspective is important in the market, and they're spending time in multifamily data centers, kind of where you'd expect right now in the market.
Yeah, that's true. The data center has been very hot on the institutional space. I think that's why you're kind of seeing even some of this yield start to expand a little bit in the multi space, because some of that capital's elsewhere right now, whether it's in more risk averse options or maybe a little bit more risk tolerant, like a data center. So it's we're definitely seeing that. Let me first introduce you, Greg. For those of you who don't know Greg Rollman's the managing director of acquisitions at Tryperion Holdings. He's responsible for sourcing, executing investment opportunities across the firm's real estate equity and credit strategies. He brings up nearly 15 years of real estate and finance experience, previously served as vice president of investments at CIM Group. In that role, he focused on West Coast markets and led originations across multiple investment strategies and asset types. So, Greg, good to have you on, and feel free to give a little bit of a background too if I missed anything on Tryperion.
Yeah, I think that covered it on me personally. Yeah, I've been at Tryperion for 2 years now. The background on Tryperion is we are a a real estate private equity firm founded in 2013, investing out of our fourth closed-end fund right now, investing kind of in that fund across geographies in the US, historically a little more Midwest or secondary market focused, and investing across product types, but not doing development. And we have some separate accounts. We're also doing some stretch senior bridge lending. So hopefully can provide kind of a little bit of an equity and debt investor perspective here.
Yeah, you guys cover the whole stack, it seems like. I guess right now, where are you guys being most successful in on the range of the stack?
Yeah, it depends again on the bucket of capital that we're investing out of. So I'd say on the equity side, we are actually pretty bullish on office and on regional malls.
Wow. Sounds contrarian, no?
Yeah, I realize that's contrarian. I think in part, especially on the office side, it's maybe a little like that, even though that is contrarian, that really is kind of going back to our roots. Tryperion historically has probably invested the most in office, not necessarily the majority of the capital has been in office, but that's probably been the single asset class where Tryperion has invested the most. And it's also in my career personally at CIM. I also did a lot of office investment. Jonathan Etra, our VP, who I know that he also was at Related and did a lot of office investment there as well, of course. So this is something where even if it's part of the market that seemingly is a little less loved right now, although I can kind of expand on that a little bit later, it's something where we feel like we have a relative competitive advantage.
Yeah. And let's get into the weeds there on this asset class that's not loved, quote unquote.
Yeah.
I think what you're finding is after COVID, there's a new era of office where before COVID, whenever you would have an employer move to a major MSA, you said, okay, major employer move, they need office space. I feel like post COVID, that correlation is somewhat disconnected. Maybe not entirely, but it just doesn't have the same correlation that it used to have. Talk to me a little bit about, from your history being in the office space, how was that correlation and that bridge before COVID, and how are you seeing it now? And what maybe is your North Star today in a post pandemic environment that allows you to understand macro fundamentals in investing in an office space?
Yeah, so I think you make a good point where a lot of the really big block users taking down hundreds of thousands of square feet, that has probably eased up during COVID. And I think we've seen a lot of that just looking around LA, for example, where a lot of the users who are taking many floors in downtown LA office, for example, like people like that, they are tending to see their space needs contracting because they had a lot of back office type uses, people in accounting, or people who were doing the sort of jobs that are a little easier to do remotely. So that's caused a lot of those kind of office buildings to see demand decrease a little bit. So I think to take maybe a step back on office, we I think are looking at office in kind of three general buckets. So you have the real Class A office. You can't see directly behind me, but that would be Century City. Like that's a market that's continuing to do great. I think rents are still all-time highs, occupancy very high, and those buildings aren't trading. But if they were, I think they'd be trading for low cap rates. They'd also be able to get great financing. You also then have like the suburban generic buildings that are not pedestrian to anything. Those buildings have been hit really hard because there are a lot of competitors for all those in the market. um, you know, Phoenix office, the call center office, that kind of thing has really been hit very hard. But where we are trying to spend time right now, and where we've closed the deal recently, is focused on suburban office, but in the best locations where you are proximate to executive housing and where your office is pedestrian to amenities. So there's a real reason to be in the office. And we're not
Mhm.
necessarily investing in like a shiny brand new building. We don't think that's completely necessary. As long as you have a functional building and where you can do a substantial amenity package, that really, I think, checks all the boxes for people. So that's the portfolio that we just invested in Indianapolis in November. That really fits that mold. And today I had a couple calls looking at other office buildings across the US that kind of fit with that profile. So that's where we're spending time. It's something where I think right now that thesis still hasn't completely been priced in. So, as I said, the Class A product, that's trading at really low cap rates. But I think that the
What
suburban,
kind of, sorry to cut you off. What kind of cap rates would you say like is like a Century City today?
I mean, with the caveat that that stuff isn't really trading,
True.
I
Yeah.
guess it's
Maybe not that many data
it's probably
points.
like a six cap, I would think, something like that. And maybe one way to kind of also just think generally about real estate to kind of wax a little philosophical here and go on a sidebar is a lot of it's really driven by the debt markets, right? I
Hmm.
think that there's always interest on the equity side, usually for deals, but what really matters when you're thinking about values, I think, is where your debt financing is coming from. And if you were going to try to finance building in Century City, you'd be able to get great long-term fixed rate financing at a pretty cheap spread over treasuries. But for what we're looking at in suburban areas, even if we think it's a really good investment, it's hard to get the same kind of financing on it. So I think
Sure.
that has really driven cap rates into the double digits.
Sure. Like going to the multi side, the safe haven from the debt perspective has always been the agencies, right? No
Yeah,
matter where the debt markets are, there's always liquidity with the agencies. And that's why it trades at such a tighter cap
exactly.
rate in general.
Yeah,
So to your point, it is driven by the debt and borrowing costs. So
yeah.
what kind of debt are you putting on the Indianapolis deal? And what part of the stack are you guys entering in? Are you common equity, pref equity, hybrid?
Yeah, so on that deal, we put, um, 5-year floating rate debt from a debt fund, and I think that was about 55% leverage. Relatively expensive in the scheme of things. Certainly a lot more expensive than your agency debt.
Mhm.
And for that, we're in kind of a co-GP spot, but also providing a lot of the LP equity. The way that we think about that is on the office side, we'd really much rather be on the common equity side because we think that even though like we believe in the thesis, obviously, it hasn't totally played out. There's still some level of risk. And if it's something that's going to have kind of a binary outcome, we think it makes more sense for us to be in the equity seat where there'd be a lot of upside and still potentially a lot of downside if it doesn't pan out versus being on the debt side where you have capped upside but still all the downside. For something in a more look like on multifamily side, we've been doing a lot of preferred equity because as you said, it's kind of a more liquid market. We think the downside's a little more capped, or at least mitigated. So for that, we'd rather do something that's in kind of the subordinated equity position.
Sure. Subordinate to the debt. Yeah, that makes sense. I think you're seeing a lot of the institutional players even having a similar strategy where they are coming in the pref equity position rather than investing as common in order to kind of protect their downside in a time of uncertainty.
Yeah. And I think to talk our book a little bit, our focus on pref equity right now on the multifamily side is really slotting into that kind of $6 to $15 million pref equity check because that's where we think is really the sweet spot in terms of getting enough scale to get the economics to make sense, but while also having a still reasonably attractive coupon. What we've noticed is that once you get to the kind of $20 million and up pref, then the rates just compress to like 12% with
Hmm.
almost no fees. And then you're getting, a
Cheaper
13
cost of
a 13
capital
IRR. And,
in
and, and
that
we're
part
we're
of yeah.
targeting more like a 15 to 17 IRR on our pref, which we think is pretty attractive.
Sure. I mean, I think with where, at least on the multi side, where fundamentals are on some of the value add space, it's hard. It's hard to come by a IRR that's higher than that on the common equity side. So to get
Yeah.
that on pref equity where you're in a safer position theoretically makes a lot more sense.
Yeah, exactly.
So it sounds like, in office you guys are playing in the co GP common side. multifamily, you've kind of found a little bit of a part of the stack in pref equity. What other asset classes are you guys playing in, and which assets classes are you guys most bullish on right now?
So I'd say we continue to be bullish on retail. We invested in some, I guess you'd call it like shadow power anchored centers where we think that the cap rates are still pretty decently high there. I think the cap rates on power center, if you're not getting like the credit anchor leases, is something in the 7.5 range or so right now. So that's still pretty attractive for us. We grocery anchored is a little too thin in my opinion right now.
Hmm.
And then kind of the little bit of the wild card is that we're doing some mall investing. So
Yes, let's talk about
yeah.
that a little bit, right? Again, coming with the contrarian play, I would love to hear
Yeah.
your investment philosophy on that.
So basically what interests us in the regional mall play is that right now the market cap rate for B malls is something in the mid-teens. So
Wow, that's amazing.
yeah, so
Wow. Okay.
which again, as I mentioned earlier, the reason why is because it's hard to get good debt on those.
Mhm.
You do see a lot of debt in the market for the A malls. I think like Simon just had some $1 billion CMBS deal that I saw, but that's again, those are for the A malls. So on the B mall side, yeah, it's like a 15 cap, and that's really something where to invest in that kind of property, you really have to kind of dive under the hood and make sure that the fundamentals make sense. And we think that on the mall side, that there are assets that are going to be evergreen and assets where it's going to be more of a melting ice cube. So the things that we're looking for on the mall front are basically uh, assets where they're kind of the only game in town. It's tough if you're like the fourth mall in a market. Like, why would people go to you versus the three better
Sure.
ones? Assets where there's actually been, relatively stable or even growing NOI versus assets where you've had the sales per square foot for the tenants remain stable or growing, and where they're also at a level of, generally the rule of thumb is like $400 a foot for the inline sales to be at a level where it makes sense for the tenants to be able to have a profitable store on average. And then also where their health ratio, which is basically the calculation of the total cost of occupancy divided by their sales, is an attractive level of around 10 or 11%. So if you can kind of check all those boxes and then also have anchor tenants that are going to be performing reasonably well, and you're not worried about issues from your Macy's or JCPenney or whoever leaving and then causing issues with co-tenancy. And then, of course, also making sure you have reasonable deferred maintenance assumptions in there. There's obviously like a lot of things you have to look at, which is frankly the case in any real estate asset. But I think if you can kind of like check all those boxes, then you can have potentially buy an asset where our view is that if it's historically been stable and we feel good that the future prospects are also going to be stable and we're not going to have any capex surprises, and we're potentially, by being a new owner who's at a more attractive basis than potentially the previous owner, we can be more aggressive about leasing and marketing and spending money, that will position us to be able to continue to do well. And if the cap rates stay the same, it's not the end of the world to own something at a 15 cap for the foreseeable future, but hopefully that we'll be able to prove out to the market that the asset's continuing to perform well and we'll have some cap rate compression.
I guess a few things to unpack that. One is, are you guys exploring any alternative scenarios for like a mall, for instance, where, a lot of people are looking at malls, they're functionally obsolete. We might need a pivot into converting that to housing or to office, or, you've heard some of these ideas. Do you
Yeah.
guys look into that, or are you really just honing in on in-place operations, making sure and just, doubling down on the asset itself?
So the repositioning play is certainly something that other people have done well, but that isn't something that we are trying to do right now. We're really just focused on buying malls as malls. Similarly on the office side, we're not trying to do office to multi conversions. Those make sense if you have the right basis in the right market, but that's not what we do, and we're not trying to do everything well. We're trying to do, the things that we can do well, do those well. So we're just focused on malls as malls.
Yeah. No, and
Maybe they have some potential upside from selling land parcels. That's great, but yeah, we're not gonna like go into it with the business model of like blowing up the RE.
and is the hold period longer term where you're comfortable with the cash flow, like kind of what you were just saying with the mall, 15% cap rate is an end of the world if you could just keep operating there? Or are you looking at something that in a 5 to 7 year horizon, you can come out with an exit that will make this give yield a little bit of a better return than what it's cash flowing at?
I mean, our underwriting is not to hold it forever. It is to sell it in the medium term. But yeah, I think our thought though is that basically we'd be okay if we basically got out at similar to our going in cap rate if we can maintain operations. I mean, if you had no NOI growth, you and you buy something at a 15 cap and you sell it at a 15 cap, you'd have some transaction costs, but like theoretically and you'd have some like leasing costs or whatever, but like theoretically you're getting like a mid-teens IRR on that, right? So
Sure, yeah.
I mean, we can push on the operations, and while that means you'll have to spend a little bit of money, we still think on these deals that are like stabilized cap is still in the mid-teens, even after spending money on deferred maintenance and tenant improvements and whatnot. We're not trying to invest with the thesis of like we have to get back to where cap rates on malls were in, I don't know, 2015 before the retail apocalypse or whatever you call that in 2016. I mean, that'd be great, but that's not necessary for us to do well with our business plan.
Yeah. Um, you had a really good thesis with office, how you were targeting areas that had walkability, but were also suburban in, I would say, affluent areas or areas where there's higher demos. What's your thesis on retail? Is it also suburban based retail as well? Or is it a is there synergies? I guess I'm trying to ask, is there synergies between your thesis with office and retail, or are they different strategies altogether?
I'd say there is some level of similarity. I don't know if there's like it's not necessarily synergistic where we would be doing both, but yeah, I mean, at the end of the day, though, what we're very focused on making sure that the surrounding area is able to support whatever project we're working on.
Hmm.
That's something where, as you know, from when you're buying, an apartment building, when we're investing in an apartment, it's not like you just, fly in, tour the building, and then you leave. You have to walk around the area, tour the comps, like see what like the dynamic of the submarket is. So I think that's really a thing that we focus on for all of our deals. Maybe that leads us to invest more in kind of suburban areas just based on what's going on in the market generally, where a lot of downtowns or urban areas have been more challenged. So yeah, I'd say maybe it's just because we have sort of a similar philosophy. We're not necessarily trying to create like a suburban REIT though, or something like that.
Right, right. No, it's interesting. I think I was, it really segues into geographic preference, right? And sometimes when you have an area that kind of fits the bill with office, it could potentially fit the bill too with malls and retail and some other asset classes. So I guess, do you guys have like a geographic preference where you're looking at it from both asset classes, that it's like, okay, this is where we want to invest and we're long on this area?
I'd say that for our firm, just given that we're a relatively smaller investor, we're not necessarily going out there and saying that we love some submarket and we're going to do like 5 deals in that submarket. It's usually more like someone is bringing us a deal, generally like a sponsor or something like that, and then we'll really dig in the submarket. We've been doing this for a while, so I think we have kind of a view on basically the submarkets of all the major MSAs. But It does mean that, like, for example, if we're going to talk about the office deal we did, we've historically done a couple office deals in the northern part of Indianapolis, specifically in Carmel. And that's really like the best submarket in Indianapolis. This office property that we purchased is in the Keystone submarket, which is adjacent to that. So it was something where, because we had spent a lot of time in the area, like we knew the brokers, we were able to get a little more aggressive with our bidding just because we had very high confidence in our ability to execute because we had executed previously in the nearby area. So I'd say like it certainly helps for us to be doing deals in the same area, but at the end of the day, we're open to looking at deals in new areas and getting smart on them, just because that's sort of like in our DNA and what we've been spending time on, historically, where we're flying to new areas, flying to new markets, trying to understand the dynamics there.
Yeah, I mean, I think that's like the best part of the
Yeah.
job, right? Is going to these areas, taking the air in, talking to the local Uber driver, talking to
Yeah,
the
exactly.
local barista, understanding where, what the sentiment is of the area, what it was before, what the good streets are, the bad streets are. That's the fun of it, right?
Yeah.
And I
Yeah. I mean,
think putting the pieces together is what it's all about, end of the day.
yeah, exactly. And that's where it's interesting where you read about like the use of AI in real estate and for underwriting. It's sort of going on a tangent about that. That's the kind of thing where, to your point, it's important to really like spend a lot of time in the area where you're doing a deal, and you can't just necessarily do it by going on CoStar and pulling the market report and some couple square mile area that's applies to your property. It's really about
Yeah.
going there and understanding the micro location and what are the reasons why someone's going to be leasing or investing in your property versus a neighboring properties. And I mean you know that from the multifamily side. That's just, again, like on the office deal that we invested in. Like that's, if you look on like CoStar, we're in a larger submarket, and I think some of the other buildings in the submarket are more challenged. So you would look at, if you look at like a submarket stat as a whole, you might be a little less bullish. But if you actually tour those other properties like we did, you see that those are properties that are isolated. If you want to go get a drink during work, you have got to get in your car. Whereas our property is walking distance from the best mall in Indianapolis and tons of F&B options. And, it's just kind of the kind of thing that you can't really, I mean, you can sort of figure it out from like looking on Google Maps, but not exactly.
Yeah, I had this exact conversation with an investor yesterday on a deal we're working on, where when you pulled the sub-market on CoStar, the rent growth looked a little bit muted.
Yeah.
And they were like, the rent growth looks pretty sluggish here. What's the story? Is there a story? And when you take a step back, and yes, you can actually pull these things online, but you wouldn't really know unless you actually spoke to people on the ground.
Yeah.
And that's where it saves you a lot of time, believe it or not. Is our property is in a is in a micro pocket where it's harder to build. It's higher demos, it's a little bit more affluent, and further north has a lot more supply hitting it and is a different renter profile. And again, there's ways that you can justify and like understand and support through the resources that you're pulling, but you wouldn't know unless you're talking to someone and breathing the air and say, "Oh, this makes more sense." When you drive these places, this makes more sense. The aha moment comes when
Yeah,
you're on the ground and talking to people.
exactly.
The future outlook, it's a little bit murky, right? We're gone through a lot and things felt like it would be a little bit more promising potentially with a new administration. But what we're seeing is still a lot of volatility, a lot of macro uncertainty. What's your personal and also Tryperion's take on the future outlook in the space you're playing in right now?
Yeah, I mean, I think that, I'm not gonna go out there and say that we have a more accurate or better view of the future than any other group. So what I think that means for us, and really for any investor, unless you're going to be a really big allocator, is just the need to remain focused on kind of the nuts and bolts of investing and ultimately making sure that your deals have, the margin of safety that's needed, right? So even if the markets move, that we're in a position where, because our sort of pro forma stabilized return on cost is a big enough spread to market, even if cap rates increase, we'll still be okay. And making sure that our deals are appropriately capitalized. So even though we are providing subordinated, debt or pref equity, we're generally not borrowing with that. And we're also making sure that, when we're doing these office deals, these small deals, these are all 5-year debt executions that are fixed rate, right? Or at least have, like some kind of cap or something where we're not going to have some kind of near term issues that are, in while we're trying to execute on our business plan, and will give us enough time to wait out any market volatility. So that's, without, I don't think that we're necessarily doing anything differently this year. I mean, it's kind of the same way that we've always been investing, and continue to be focused on just being conservative and reasonable, and not pushing too hard on any specific metric, right?
Yeah, I think we're having a similar approach where we're solving still to the mid-teens return, but that mid-teens return has a lot more conservatism baked in, right? Where you're not stretching on any metric in particular. You're pounding the underwriting in ways that you're stress testing it, that even if that happens, you still feel good with the deal. You're leaning in more on in-place economics. Similar to what you were just saying about the mall investment, where we don't need to bank on future outlook being better. If a deal works with in-place metrics today, we'll be okay with it. And cash flow, worst case scenario. And best case scenario, you get appreciation. So I think we're kind of looking at it the same
Yeah.
way and staying disciplined and kind of seeing through the smoke and mirrors in order to pick our spots.
Yeah, and I think, even if you're doing what you're doing on the multifamily side, even though there's volatility in the market, I think it's important that you still have like the agencies lending at, I think, pretty attractive rates. I saw an article last couple of weeks about how, I think it was Freddie is continuing to tighten spreads. So, I don't quote me on it. I think agency all-in rates are probably in the mid to high fives right now. So,
Sure. Yep.
I mean, as long as you're not,
Potentially tighter if it's mission driven. But yeah,
yeah, that's true. So, yeah, so I think for someone like you, where you're doing value added retail, if you can feel really confident about your execution of your business plan, like it can still make sense to invest today, because even if you're concerned about things like rent growth, you're not buying like a 2021 vintage deal at a 4 cap because you're going to have some crazy rent growth. Like it'll be okay, because you'll be probably going in at a cap rate that's similar or higher to your debt interest rate, and they'll have a nice debt yield there, and you'll have a good margin of safety.
exactly. I think the basis all looks great on paper relative to peak values and well below replacement costs. So you're good there. Your yield is at or above where your borrowing costs are. So accretive financing, positive leverage going in, and cash flowing. Sure, it might be similar to what something that's more liquid like a CD could yield. But the idea is that you're going to get appreciation, you get depreciation too,
Yeah.
and tax sheltering. And so that gets taxed, more tax advantage instrument for cash flow. So I think the 3 to 5 year outlook on multi is pretty strong right now.
Yeah, and no, I think that the other thing on the multi side too is, like, probably the biggest source of uncertainty right now in the markets is around tariffs. And probably the most direct impact on real estate for tariffs is going to be around things like construction costs. So, uh, if you're doing value add multifamily, uh, I guess that leads to some level of uncertainty for renovation costs. Hopefully for, if you're a group that's done a lot of it, you should hopefully have a relatively well-oiled machine. Even though you have that negative, I think the big positive would be a reduction in new supply if you just have continuing issues around construction costs. Since, to your point, I mean, you're seeing in Texas people selling deals in lease up that were recently delivered for meaningfully below replacement cost.
Yeah, I heard at a conference last week I spoke at that Houston lease up deals 140, 130, 140 a door. I was shocked. And it goes back to your point too. Before the tariffs, there was high capital cost of capital with borrowing costs. You still had higher construction costs just from the supply chain issues. And then now with the tariffs, it's almost like the nail in the coffin with supply.
Yeah.
What does that mean? I think with multifamily, that means a really strong 2026, summer of 2026. I think you're starting to see positive trade outs now in 2025. And this is kind of the calm before the uptick of the cycle. And, everyone knows this is a cyclical market. And I think these patterns that you're seeing with muted construction forward looking is a recipe for success for future rent growth heading into, second half of 2025 and 2026.
Yeah. And I think on some of those properties that, in Texas, the challenge is that you still have a lot of absorption to work through.
Mm-hmm.
So as long as you're capitalized in a way where you can deal with some softness for like 2 years, I think you'll eventually be in a good place. But you have to be able to ride it out for a bit while things still absorb.
Yeah, every submarket's kind of different, right? You have Austin, which is like the poster child of going to be the last one to recover, and people are still even playing in that space and being extra contrarian, buying in there and saying, "I see this long term. I see the pain and the blood on the streets, but I'm willing to place a bet today and just ride it out for as long as I can." And then there's some other markets where you've had that glut of supply, but you're seeing that it's getting absorbed really well. The inbound migration is helping take that supply on, and then supply is falling off a cliff. So it only makes the story even better from a value add multifamily perspective.
Yeah, yeah, I agree.
So, Greg, I mean, you've been on all these panels and on online. I'm sure everyone's trying to get a hold of you. What's the best way for people to reach out and get a hold of you and connect with you?
Well, please send me an email at grollman@tryperion.com. Always happy to look at new opportunities. And just to reiterate what I was touching on at the beginning of the podcast, we're doing pref equity, co-GP equity, some LP equity, targeting 7 to 20 million-ish dollar check sizes across the U.S. and all asset classes except development. And then we also have an account that's doing stretch senior bridge loans, targeting 10 to $50 million loan size with usually about 2-year term, kind of more transitional business plans usually. So we're like to think that we're kind of opportunistic, creative, flexible. So appreciate any inbounds.
Awesome. And Greg's email will be in the show notes. Thanks everyone for listening and hopping on. Happy Friday, and we'll talk to you next week.
Thanks so much, David, for having me.
Thanks.